Welcome to The Explainer. Ever look at a company's profits and think, is that for real? Well, today we're pulling back the curtain on some really clever accounting rules. These are the rules designed to stop companies from, cooking the books and make sure their financial reports tell the actual story.
All right, so here's the plan. We're going to start by breaking down a classic management trick. It's called the Big Bath. From there, we'll jump into the specific rules that are basically a litmus test for what's real. Then, we'll get into the weeds on possible versus probable, and trust me, it's a huge deal. And we'll wrap up by figuring out what on earth you do when big news breaks after the financial year is already over.
Okay, so first up, the big bath problem. We got to start with the problem itself, right? For years, there was this massive loophole in financial reporting, one that savvy managers could pretty much drive a truck right through.
And it really all comes down to this one question. How can a brand new CEO use a little bit of accounting magic to make themselves look like an absolute hero, like a turnaround genius, almost overnight?
So here's the playbook, right? A new CEO steps in, and one of their first moves is to create these huge provisions for all sorts of vague future costs. This is what's called taking a big bath. And what it does is it completely tanks the profits in their first year. But here's the genius part. They can just turn around and blame it all on the old boss. Then, a year or two later, they quietly reverse those provisions, which creates this artificial profit boost. And suddenly, they look like a hero. It's brilliant, really. It's all about managing perceptions, not actually managing the business.
Well, as you can imagine, regulators eventually caught on to this little game. And to shut it down, they came up with a really strict rulebook. It's called International Accounting Standard 37, or IAS 37 for short. And its entire mission in life is to stop these kinds of vague, manipulative accounting moves. So what even is a provision anyway? At its heart, it's basically a liability, but one with fuzzy details. Think of it like an IOU jar on the company's shelf. They know they're going to have to pay someone for something, but they're just not 100% sure exactly when they'll have to pay or exactly how much it's going to be. A product warranty is a perfect example of this. And this is where IAS 37 really gets tough. To stop those big bath shenanigans we talked about, a company can't just pull a provision out of thin air. Nope, it has to pass a super strict three-part test. First, there has to be a present obligation from a past event. Second, it has to be probable, more likely than not, that they'll have to pay up. And third, they have to be able to make a reliable estimate of the cost. You got to check all three of those boxes. No exceptions. Now, that first part, the present obligation, it actually comes in two flavors. You've got your legal obligations, which are pretty straightforward. They come from a contract or a law, like that product warranty. But then there's this other, more interesting type, a constructive obligation. This is where the company's own actions have created a totally valid expectation that they'll pay. Think about a store that has a famous no questions asked return policy. They've created an obligation through their own behavior.
All right, so that's the rule for things that are probable. But what about all the maybes out there? What's a company supposed to do with a potential liability that's only, possible?
Well, that's where we get into something called a contingent liability. And that's just a fancy term for the financial what-ifs. The perfect example is a lawsuit. Let's say a company is being sued, but their lawyers are pretty sure they're going to win. There's a possible obligation there for sure, but it's not probable.
And this table here, it's basically the decision-making flowchart. It's all about probability. If something is virtually certain, like over 95% chance, it just gets recorded as a normal liability. If it's probable, that's anything over 50%, bam, it's a provision and it hits the bottom line. But now, look at that middle ground, the possible zone, between 5 and 50%. This is the key. These things don't touch the profit number at all. Instead, they have to be disclosed in the notes to the financial statements. And that, my friends, is why the smartest investors always read the fine print.
Okay, let's totally switch gears for a second and talk about a different kind of timing headache. Imagine this. A company closes its books for the year on December 31st. Everything's done. But then, something huge happens in January or February, before they've actually published their annual report. What then? What if their biggest customer goes bankrupt or a huge factory burns down? So you've got this weird limbo period, right? This gap between the year end and the day the accounts are actually signed off and made official. This is a really critical window. And luckily, there's another rule for that. It's called IAS 10. And it's the official guide on how to handle these kinds of late-breaking surprises.
Now, IAS 10 makes a really elegant, simple distinction. It all boils down to one simple question. Does this new thing that just happened give us more information about a situation that already existed on December 31st? Or is it a completely new thing that only cropped up after December 31st?
Let's walk through a couple of examples. I think they'll make this distinction totally clear. Okay, first up, an adjusting event. So a huge customer goes bankrupt in January. Now, the bankruptcy itself happened in the new year, but it's really just the final confirmation of something that was already true back on December 31st. That customer was clearly in big trouble then, which means the debt they owed was already shaky. So the company literally has to go back and adjust its December 31st books to show that that debt was bad. All right, now for the other side of the coin, a non-adjusting event. Let's say a factory burns to the ground in January. That fire is a completely new event. It tells you absolutely nothing about the state of the factory on December 31st. On that day, the factory was fine. So in this case, the company does not go back and change the numbers. But because a factory burning down is obviously a huge deal, they are required to disclose it in the notes.
So let's wrap this all up. What's the big picture? You've got IAS 37, which stops the whole big bath game by making sure provisions are based on solid probability, not just a manager's whim. Then you have IAS 10, which freezes the financial statements in time, making sure they're a true snapshot of how things were on December 31st. At the end of the day, the goal for both of these rules is exactly the same: to give all of us a true and fair view of what's really going on with a company's finances.
And these rules aren't just nerdy stuff for accountants. They're actually really important tools for anyone who wants to understand a business. They force a level of honesty and transparency that might not otherwise be there. They give us the power to look beyond the big, flashy profit number. Because as we've seen, the real story, with all the risks and the what-ifs, is so often hiding right there in plain sight in the notes.